Hi, everybody. This is Boris Schlossberg. Welcome to our 10th installment, 10th and final installment of our Funda Masterclass webinar series. And the final episode is going to deal with how to put together a logical trading plan. Basically, how to put together all of the ideas we've discussed into a logical trading plan for all of us to use going forward. As always, past performance is not indicative of future results. Trading Forex carries a high level of risk, may not be suitable for all investors. So I ask you to read this kind of very carefully to understand all the risks associated with trading in margin and to seek advice from an independent financial advisor if you have any doubts. So, how professionals put together a logical trading plan and strategy is the topic of our conversation this final session. And we're going to really drill down on a lot of different aspects about what makes a good trading plan. Some of it you may find quite surprising. If there's anything that's unclear as I go through this, of course, feel free to just post a question. I'm happy to answer anything as we go along. But generally, it should be relatively self-forward. And as I said, all of this is going to be available in a PDF format, so you can go over these ideas over and over again. In fact, I highly recommend it because of all the resources that we have, this one is probably going to be the most valuable in terms of as a long-term, enduring way for you to refer to what I would call designing a good trading plan for everybody to trade going forward. Because we, of course, look at trading not as a one-time affair, not as something that you just, engage in for 5 or 6 months and then just kind of drop like a hobby, but a full lifetime engagement. If you want to be a full lifetime trader, you need to have an idea of how you're going to plan your trades and how you're going to create that whole lifetime plan for trading intelligently. So first and foremost, you really need to think like a hedge fund manager, which I think a lot of retail traders don't. I think a lot of people think in a very much a lottery format where, give me a hot trade, let me just have a hunch, bet a bunch, is what we used to always say on Wall Street when I used to work on Wall Street, which is a typical approach of a retail trader. And there's a reason why an average retail trader blows out in 3 months because of precisely that approach. And hedge fund managers, of course, don't have that approach. They have a much more intelligent and much more durable approach of how they decide and create their own businesses. First and foremost, we've sort of divided this into 6 key steps, but I think first and foremost is they define a strategy that they want to trade. And very often it's quite okay to actually define 2 separate strategies that could be opposite to each other. In fact, that's a very, very common, very popular format of hedge funds. In fact, I would say it's one of the most durable formats of hedge funds. It's called the multi-strategy fund, where they will trade lots of different, sometimes offsetting strategies. In our day trading room, we have now settled on actually 2 diametrically opposite strategies. One is a phase strategy that I showed you, and the other one is a trend strategy. In combination, both of them actually provide a much more robust result than just relying on one or the other. So defining a strategy does not mean exclusively trading to one strategy, but having a clear idea of what each strategy does. Then, of course, risk, which politely is referred to as money management rules. It really should just be called risk, because that's really what it's all about. How much you're going to risk on any given trade, on a series of trades, is a critical component to how you're going to run your business. And really, there's only 2 ways to make money. Everybody wants to make money the following way. They want to risk very little and consistently make money a lot. So in other words, they want to risk $1 to make 2 and be correct 80% of the time. That never, ever is going to happen. That will never happen. And everybody who chases that dream is only going to come up with a nightmare. There's really only 2 ways to make money. You either risk $2 to make $1 and try to be 70% or better accurate, or you risk $1 to make $2 and try to be 35 or 40% accurate. You're never going to be more than 50% accurate with a highly positive risk reward strategy, and you're never going to be extremely. You're going to have to assume a huge amount of risk if you want a highly consistent, profitable strategy. So it's very, very important how you define that risk. And the ideal thing is to sort of find some happy medium where you take on risk, but it's against a as high a probability as possible, and then you mix the two together, depending on how you like trading it. And then, of course, very, very important to test continuously, and not just test at the beginning. Oh, I'm so sorry. It's flu season in New York, so my apologies. Not just to test, at the beginning of your journey, but to test continuously throughout. Our day trading routines have changed considerably over the couple of years that we ran the room, and they continue to be changed all the time. I'm never sitting satisfied. I'm always looking for new ideas, new angles. So testing is a lifelong process, just like trading is. And then, of course, it's very important to understand your actual performance to what your expected performance is. That really helps you assess what you're doing correctly, what you're doing incorrectly. And also, it's very important to understand against that performance where the drawdowns come in. Like, for example, there are situations, there are market environments where counter trend trades are just going to do continuously well. And then the market is suddenly going to go into a massive trend momentum movement. And all of a sudden, all those counter trend trades are going to do poorly, and you're going to go into a drawdown. Well, if you don't understand that's a function of sort of a short-term shift in market regime, then you're going to think that your strategy doesn't work. But in fact, it works fine. It's just simply the wrong strategy for the market regime. So you have to either dial back or wait till the market regime changes that's more favorable, or what we do, which is try to create an offsetting strategy that performs well in that market regime. But it's really, really important to understand why the drawdown happens. If drawdown is happening because you're making mistakes, or because the strategy is literally not doing what it's supposed to do over a long period of time, then it's clearly a signal to you that you need to abandon it. But if it's a function of a short-term response to a sudden change in market regime, you need to understand all those things as you're creating your strategy. So let's take a look at all these things in more detail. First of all, defining a strategy, right? We have to ask ourselves, what kind of a strategy do we want it to be? Is it going to be fundamental or technical? Fundamental strategies, of course, are going to be driven by the big macro conditions that we talked about, right? The 3 M's of macro: monetary, macro, and micro. Sort of your long-term bet on interest rates, your long-term bet on growth, and your shorter-term bet on economic conditions on the near term. All of those things are really fundamentally driven, and if once you start making those calls, that's where you're going to make a decision of what kind of fundamental strategies you're going to trade. Technical strategies, of course, are based strictly on price movement, and their function is really of whether you're going to trade trend or fade trend, right? There are really only 2 trades you can ever make. You can either bet against the breakout, or you can bet with a breakout. That's really it. You either bet the price action is going to fail, or if price action is going to continue. If it's continuous, that's a trend regime. If it's a failure, that's a range regime. And you trade one or the other depending on what kind of a strategy you make. But there's really only 2 strategies. Everything else is kind of really derivative. And then, of course, there's just sort of a duration period, something that could be trend on a short term, could be very much range on a medium term, and could again be trend on a long term, right? All depends on the kind of perspective you have and the kind of the time duration you're going to look at. One huge thing that I find most retail traders completely overlook and never really assess as importantly as they should is what currencies will you trade. One of the biggest mistakes I always see is people will take one of my strategies, which are designed strictly for majors, and then trade 25 different crosses with them, and then come back to me and go, hey, how come it's not working? Because it's not the same instrument. There is a massive difference between the major currency pair and the cross currency pair. The major currency pair is basically going to be an expression of direct response of that particular currency against the dollar, right? Versus the crosses, those are all relative strength bets. And those relative strength bets are completely contingent upon, it's basically, in the majors, you only have two variables, pro-dollar, anti-dollar, within the particular currency that you're trading. With a cross, you actually have four variables. The more variables you have, the less you're able to predict this price movement and the less handicapable those price movements are. So, I find it actually always amusing that people like to just say, oh, it's a trend strategy. Let's trade it on the cross. And it fails miserably because they don't take into account that that's not the same instrument as a major. Then trading, of course, time frames is another huge difference. There's a massive difference between trading the hourly and the 5-minute or the 15-minute, and yet another massive difference between trading the daily and the short term. One other thing that a lot of people don't appreciate is if you are in a position after 5 o'clock New York time, you will be charged interest unless you're in a positive carry position. Then you'll be collecting interest. I mean, there are huge. There used to be a long time ago when we used to have interest in the currency market, huge amounts of strategies that were carry trade positive. These days, that's not as much of a big deal, but it's actually a punishment if you're in a negative carry position. Sometimes people don't quite understand that if let's say you're in a long-term position, long euro dollars, just for argument's sake, just long euro dollars. Remember, the dollar rates now are higher than the euro dollars. So if you're long euro dollars, you're getting punished every day by my platform is down, but probably almost as pip, maybe as much as a pip and a half a day. So if you're holding a position for 100 days, you've lost 100 pips just to interest costs. That's something that, for example, I as a day trader never incur because I'm always flat before 5 o'clock New York time, so I never have interest in my position. Those are things you need to think about when you're constructing the strategy. Another thing that you need to think about is if you're a short-term trader upon whom you're basically trading sort of small 5, 10, 15, 20 pip movements. If you hold a position over the weekend, certainly not always, but at least once, most likely twice, and very, very often, maybe 5 to as much as 7 times a year. That's 5 to 7 times a year. You could be in a position where you will lose 100 to 200 points on a gap open. In fact, I've seen so many traders lose so much money on the gap open, I can't tell you. I mean, hundreds of thousands of dollars because they went in long on the euro, and then boom, something happens over the weekend, and boom, the euro drops 200 points. So you need to understand that anytime you're holding over the weekend, you have a 1 in 5, 1 in 7 chance of losing a couple of hundred pips if you're on the wrong side of the trade. And that's a very, very important component of how you should be thinking about. Now, money management rules, that's another very, very important aspect of constructing our trades. There are literally 100 different ways of how you could manage risk. The most sort of, I think, flexible is what's called multiple entry, multiple exit, where you come in entry 1, entry 2, sometimes maybe even entry 3, and then exit small position, position when it's in profit a little bit, then maybe more in profit, then finally last profit. You can do single entry, multiple exits. You can do multiple entry, single exits, which is something that we do all the time. The reason why people do multiple entries and quite often multiple exits is because prices are not precise. Basically, trading is a probabilistic enterprise, right? Probability. It's a sort of a you can't predict the perfect bottom or the perfect top. You generally have a range, and because you don't know ahead of time, where that range is and where that range lies, it's usually very helpful to kind of have a series of probative positions around that range that give you a much better blended entry than your initial entry. That's sort of the underlying thought of why people do multiple entries. Some people will simply say, no, I'm willing to do single entry because I'm willing to endure lower accuracy for less risk. It's all up to you, but you need to understand why and how each one of these things is done, and what are the reasons for why people do it. And the underlying reason for why people do this is because of probabilistic nature of price. Price is almost never exact. It always overshoots or undershoots, and that's why people come in with multiple entries and multiple exits into a position. That's quite different. This is a very, very important point. From just martingale into a position, from just averaging in or continuously into a position. A multiple entry, multiple exit position knows ahead of time, before the even trade plate is placed, how many times you're going to come into a trade, at what levels, and where you will stop hardcore if you're wrong. If you don't have that ahead of time, then you're just simply gambling on a martingale basis, and you will lose much faster than you even think you will. You could lose, sometimes you can last for a month, but most of the time you won't survive more than a week martingale into a position, right? And then, of course, the exiting is also a very, very wide range of options where you can take profits based upon specific hard targets, based upon percentage targets, based upon trailing stops, all sorts of ideas, or based upon just proprietary, market sense. I very often take early exits on my positions if I don't like the market price action before it, hits a take stop. So a lot of it is very, very contingent on your own preferences. Now, testing is just an absolute necessity of how you should trade. It doesn't mean that you have to code. Coding is a wonderful skill, and if you know how to code, it makes your life extremely easy. But generally, I think people tend to incredibly overweigh past results. One of the biggest mistakes I see people do is they'll test something for 10 years back with 1,000 samples, and then feel really confident, and then boom, in the first month, nothing works the way it's supposed to. And they go, well, I had 1,000 samples. How could this happen? Well, because it didn't matter what happened in 2004. What really matters is what's happening in the last 3 months. What's really happening in the last couple of months. You really don't need more than 20 to 30 samples to give you a feel of whether your strategy makes sense or not. Now, what is valuable, what is really, really useful, is then to say, okay, this looks interesting, looks promising, strategy seems to be working now. How about I'll pick random 3 months, the year 2006, and let's see how that strategy works in that year. Just what's called an out-of-sample test. And the out-of-sample test doesn't have to be more than 15, 20 samples. You could do this all visually. But it would give you, but if you do an out-of-sample test and then it works then, it gives you more confidence that it's going to work now. Look, bottom line is nothing will tell you how things are going to work forward. But testing them at least gives you some idea of how they worked in the past, and that gives you some idea of how you want to construct your strategy, right? Understanding performance is very, very key. What is the percent of winning trades that you can expect? What is the percent of winning trades that you need? And what is the profit factor? The profit factor is a very, very good measure of profitability. It's basically your total gross profit against your total loss. Generally, if your profit factor is 1.3 or better, you're doing a great job. That means you earn 130 cents for every 100 cents you lose. If you have 1.3 or better profit factor, you're doing very, very well. One of my all-time favorite risk performance measures is something that very few people actually do, but I think it's really valuable, and that's total performance against total drawdown. Let's say you're up 12% this year, and your maximum drawdown was only 4%. So that's a 4-to-1 ratio of your total performance to your total drawdown. That's an extraordinarily good performance. Generally, if you ever find a situation where you make 10% in a year and you've only drawn down 5%, you've got yourself a winning professional strategy, and you should stick with it. That's the rule that Paul Tudor Jones uses, essentially to evaluate if he's doing a good job or not. And that's about as good as you can get. It's really all about how much how much money you earn against how much money you lost. Very often, you'll see some people sometimes will show you, oh, I made 50% of my money, and then you see that somewhere in their performance they had as much as a 70% drawdown, or they had or their drawdown was like 50%. A trader who made 50% of his money with a drawdown of 50% is nowhere near as good a trader as a trader who made 10% with a 5% drawdown. Just want to make sure that's clear to everybody. Oops, I'm going the wrong way. There we go. And so this sort of, I kind of ran ahead of myself. I'm saying drawdown is precisely that. It's about this idea of what is the maximum, I think, drawdown against what is the maximum run up that you've had. That's a very, very good way of evaluating whether you have something that's good or something that's bad in terms of your strategy. Now, so one very, very important factor, one incredibly important factor that retail traders continuously underappreciate is the leverage factor. And I always present this to a lot of people across the world. We call it the table of doom. And it's a devastatingly simple example of how you can destroy your account. Devastating simple example, how you can destroy your account with very little leverage, with just a very modest amount of trading. And it basically does the following thing. It assumes something that is almost virtually guaranteed to happen. If you do, 300 to 400 trades a year, let's say you do 500 trades a year. If you do 500 trades a year, the probability that out of those 500 trades, you will have 1% losers, right? 5 losers in a row at 1% is like 90%, maybe even 95%. It's almost assured that sometime around, 500 trades, you're going to run into a bad luck of trades, and you will, have five negative trades, right? Now, if you don't leverage at all, you just trade 10,000 units per $10,000 in the account, and you have 5 consecutive losses of 1%, you still have 95% of your capital left at the end of that negative run. You're at 9,500. You've preserved almost all your money. At 2 to 1, you preserve 90% of your money. So you're still in pretty good shape. So I would say this is what I would call a relative, zone of safety, right? At 5 to 1, which is a very, very modest leverage, and most FX traders laugh at this kind of leverage, right? You've already lost nearly more than 20% of your money. And at 10 to 1, which is what everybody starts out as their conservative position, the conservative position is 10 to 1. You've basically lost 40% of your money, and your chance of recovery is you're going to need to make 70% of your money just to get your money back. Here, you need 5% of your money. You just need to make 5% of your money to get back to even. Here, you need to make 70% of the money. What is much more likely? What are the chances you're going to do this? I think the chances of this are basically 1 out of 100, whereas the chance of this is probably like 60, 70 out of 100, right? So, what is a much more realistic chance of you staying alive if you keep your lever factors very, very low? And this is another dramatic way of just sort of explaining this, where if you lose 25% of your money, you need 33% of it to get back. If you lose half your money, you got to double it. If you lose 3/4, you got to go four times your money. And if you lose 90% of your money, you have to do 10 times just to get back to original equity. Your chances anywhere around here are virtually zero, which is why when people kind of breach the 25% barrier, most of them begin to lose all their money because the recovery rate from that point on is impossible. There's a question in the room here about how long the recordings will be available. The recordings are available for at least a year, generally much more so. So you have plenty of time to access all the recordings for as long as you want to. Plus, you can download all the PDFs, so you have them forever, right? So the sixth thing that we want to look at is sort of improvement. What works and what doesn't. One of the losing trades usually done. Does news have a positive or negative impact on your strategy. It's a very, very important aspect, right? Huge part of my life is spent on avoiding news, closing down ahead of news, being aware of news. And that's because a lot of my strategies are counter-trend strategies. And news, by definition, is a very trend-based variable, right? And also specific times of the day. I'll speak a little bit about what are the really, really hot times and the cold times of times of the day. Those things are all very important. And then I wouldn't say cutting losses early, but I would say, is there a way to cut losses that doesn't affect your accuracy? Or that for example, where the cut and the loss creates such a small drop off in accuracy that it overall is positive. That's really the art of the game, is figuring out how much you can lose, how little you can lose, and still preserve your accuracy edge. That's really, really where it comes down to, and that's what really matters. Now, sort of for those of you to understand, professional money managers basically almost never risk more than 5% of equity, and I think generally the rule of thumb is, and I'll get into this actually a lot more in detail a little bit later in this session. If you're day trading, if you are making, let's say, I don't know, between 20 and 50 trades a year, then you could consider risking maybe 5% of equity on a position maximum. If you're making 100 trades a year, you could consider risking 1%. If you're day trading like me, you should never, ever, ever consider risking those numbers on a particular trade. And I'll explain that a little bit. But these numbers are really only if you're making less than 50 trades a year. That's what you should be thinking about. If you're doing anything more than 200 trades, none of this applies to you. I have completely different numbers for you to consider. And also, if you have any expectation of doubling your account in a year, then you basically are not trading. You're gambling. Now it's fun. You could have fun. You could have, if it's cool. I mean, I think it's really cool to try to double your account, as long as you understand that you're virtually guaranteed to lose it, right? That this is not money. That this is just fun money, and I'm going to see if I could double my money, and I don't really need it, and I'm here for the game. But if you're here for like serious, if you want to trade for the long run, if you want to trade for 20, 30 years, if you want to take 10,000 and maybe run it to 500,000 in 20 years, then you have to have completely different ideas about how money is made. Money is made between 8 to 12% at a time. That's the best returns. If you can do 20% on your money trading FX in a year, you're doing super great. And over a long time, you're going to do great. But I think that's one of those sort of underlying ideas that most everybody who trades FX really doesn't understand. You can totally go for doubling your money, but then understand that you're just gambling, which is fun and totally cool. And maybe you have 2 or 3 years where you could take 10,000 to 20,000 to 40,000, and then by the third year you'll give it all back. But it was fun while it lasted. But understand what you're doing. You're just basically going to the horse races. Whereas if you wanted to really take 10,000 and grow to 100,000, it would take you 6 or 7 years of 10 to 15% returns on a continuous basis to do that. Here's a good example of what I call a professional money management trading, and it's not by no means pretty, right? But what you'll notice here, and I think it's really, really interesting, is this is all percent wins, percent losses. Look what they're doing. Look what they're losing. They're losing less than 1%, right? I mean, they're winning only maybe 1 or 2% also. But look how controlled they are in their losses. 99 basis points, 156 basis points, 19 basis points. Well, here's by the way, a hugely bad run, really, really bad run of really bad trades, right? But at the end of it, he still hasn't lost more than 6 or 7% of his money, right? And he's able to get some of it back here as he goes forward. This is how professionals trade. This was taken from UBS hedge fund, FX hedge fund trading run. And I just wanted to give you a sort of a eagle's eye view of what professionals do versus retail traders, right? So let me just sort of stop here. Any questions? Anything else on your mind before we proceed? Let's get down to business. Sort of see how do we create ideas? How do we find those ideas to populate those trading plans? Right? Looks like everybody is pretty clear. So I'll proceed to our second half of our presentation. So the first thing I think is really, really important is trading plan equals business plan. If you don't write it, you don't do it. Now, I am, one of the world's worst writers, right? I mean, I don't have. There are people who will like create these incredibly beautiful looking Microsoft Word documents or PowerPoint documents, or they'll create a big, Excel spreadsheet, and they'll think about everything, and they'll jot it down, and they'll refine it, and they'll create super great notes. I'm never a guy who's going to take great notes, right? But I'm a huge believer in writing stuff down. So, I've actually, I'll actually show you what I do. Because I'm so lazy and I'm so badly disciplined. There's this little product called, is it John? Let me just make sure. It's called Boogie Board. It's literally costs like $15. And it's a digital product, right? You write it, it sits on your desk. You can write it, then you hit this button and it erases it. And the way they have like a little app where you can write down your notes, take a snapshot with your iPhone, and all of your notes will automatically then just aggregate into a little folder, so you can access all of your notes. And just the act of writing something down is extraordinarily good at centering your ideas. Okay, it will focus your ideas like no other thing. So even if you're not the perfect note taker, it's really important to have a trading plan that is written down, right? So you got to ask yourself, why are you entering a trade? What is the reason? You may have a certain price structure. You can say, there's a certain behavior pattern in price that I see, and I want to take advantage of that behavior pattern. Why am I, exiting the trade? It can be literally as simple as saying, that's as much as a risk as I'm willing to take, right? Now that may not be the best idea, but it's an idea. But you have to have a decent idea of why you're going to exit as well as why you're going to enter. And then, how much am I willing to lose? That's a function of both. It's a function of both a stop and the leverage that you're going to apply to it, right? And you just keep working it. The thing about this is the single biggest mistake is to think that you can create a plan, write it down, and it's going to be the plan. No. When you create a plan, write it down. That's just the first draft, the outline, just the first version of multiple versions. When you guys look at the EA that we have in the box there, you'll see the EA itself is .23. What that's showing you is that's a 23rd version of the code. Not forget even the strategies, just the code itself. And that's very much what trading is all about. It's endless variations of the code, because you constantly have to be in touch with the market, aware of the market, and understand how the market changes. So you have to be very, very flexible. Strategies are not static. The general concepts behind strategies are generally static, but the strategies themselves need to be adaptable to market environments. And how do we find trading ideas? Well, very simple. There really is no way better than by watching. I mean, obviously you could take ideas from me, which this is what we exist for. We exist for creating ideas, and people love to take my ideas. And very frequently what happens is people will take our ideas and modify them completely differently from what we do, and then create their own structures and strategies against those ideas that work very well. Very often, all you got to do is just simply watch. Now, watching requires time. Watching requires focus. Watching requires intensity. So it's not just a simple measure of saying, you can look at the market once and then you'll get an idea. No, you have to look at it for a long, long time to kind of understand what's happening. my whole job all the time is basically observation. And I'm constantly, it's always amazed me at how I'm always discovering just a couple of new interesting things about the market that tweak my approach just a little bit better, just a little bit better. And sometimes it'll take a year to appreciate something that is just obvious. It's sitting in front of your nose and you just don't notice it until like it's over and over and over again. Sometimes you just have to step back. But basically, speculation is always observation, and it's the powers of observation that help you become a good trader. That's really what it's contingent on. So we are very visual beings, and that's why we respond very well to chart patterns. Chart patterns are effectively expressions of sentiment, right, of behavior patterns. So what we're constantly looking for in chart patterns is any kind of behavior patterns that make sense, that can be handicappable, and they can be repeatable. That's really what trading is all about. It's about finding the behavior patterns inside, and that's how we create our trading plans. So is history a good guide for the future? Yes and no. So Mark Twain said it best, I think, that history doesn't repeat itself, but it rhymes. And what it means is that everything that happened yesterday is useful to what's going to happen tomorrow, but tomorrow could be just a little different enough that it could screw you up. So you need to just constantly be aware of the fact that tomorrow could be not quite as similar as yesterday. And that's why you constantly have to adjust and observe the markets, right? But how do we find the rhymes of the currency market? Basically, we trade. And at the beginning, and this is a thing that I'm completely for it. If you're new to the market, there are two ways to do it. You obviously can piggyback off people who've been trading for a long time and look at their ideas and use their ideas. That's a great way of starting to trade. But then you're eventually going to want to figure out your own ways that are more conducive to your own personality and to how you want to trade. And you're always going to experiment. And I'm a huge believer in experimenting. And it's okay. It's actually totally okay to screw up, to make mistakes, to see, well, if I did this, what would happen? If I did this, what would happen? Oh my God, I did this and it's so stupid. Now I lost so much money. I can't believe I did this. It's all great as long as you trade small. You literally have to just say to yourself, I'm going to make a lot of mistakes, but I'm going to make very small mistakes. I'm not going to trade large amounts of money. Where everybody gets into trouble and where I've seen, the difference between people who succeed in this business and people who don't is the people who succeed in this business is by no means do things better. They are simply willing to be more patient. And the reason why they're willing to be more patient is because they've willing to take much smaller losses. They're not they don't let the ego get in the way. They don't try to fight the market and win by throwing money at the market. Nobody can beat the market no matter how much money they have. And it's the single biggest, easiest way to lose money to the market is by trying to bully it with your money. Your money is a drop in a bucket to the market, and the market will take it all away if you keep pouring into it. So there is no substitute for practice. There's no substitute for being engaged with the market. And most importantly, I really, really believe this, right? We obviously, of course, learn through playing and experimenting, but the single most important thing, in my opinion, is to not trade a demo. There's nothing worse than the false experience of a demo. Now, let me put it this way. A demo is a great way to learn the platform, right? And even then, I honestly, very often, even if I'm new to a platform, I will trade it live just to see the kind of mistakes I'm going to make live. Demo's only value is if you decide to just learn how to buy and sell, how to create a chart, how to do all those things on a platform. Even trading dime pips, tiny little pips, where each pip is worth a dime, is a completely different mental experience than trading a demo, right? And I highly believe that you start with dime pips, you move to dollar pips, you keep trading that, and if you feel comfortable, then you go to $10 pips, whatever. It's up to you. But trading live is a huge, huge difference to trading demo. And the only way you begin to learn is by trading live, right? Live trading, of course, is these two benefits. It's real market conditions, and it's your true psychological reaction. Doesn't matter whether you have $10 on the line or $100 on the line or $1,000 on the line, you're going to be pissed when things don't go your way in a way completely different than if you had $1 million of demo money on the line, right? Because first of all, the other thing about demo money is it lulls you into that false, assumption. Well, I'll just throw more money into it. I'll just throw more money into it because who cares? It's demo money, right? And you get into that very, very bad condition of trying to throw money at the market, especially if it's not real money. But if it's your real money, you're going to think twice. Do I really want to throw another $100 into the market to prove myself right? Do I want to throw another $1,000 into the market to prove myself right? That sometimes stops you from doing the stupid things. Not always, but at least it's a beginning. That's why trading real money is much better. Now, the other thing that I think a lot of people don't quite understand and don't appreciate is that the value of the strategy is not so much the value of the strategy itself, but whether you yourself will use it. I am very, very comfortable selling tops and buying bottoms, right? I like to be on the opposite side of price action. A lot of people are not. If you're not, it's extraordinarily difficult to make money. You're not going to be successful doing things you're not comfortable with, right? Because what happens is trading very often is a function of not hesitating, of trusting your setup. And if you're not comfortable with what you should be doing, you're not going to trust the setup, so you're going to pull it. And generally, you're going to always pull it when things work for you, and you're going to enter it when things don't work for you. It's the Murphy's rule of trading, right? Now, other traders are very comfortable trading breakouts. I'm really uncomfortable trading breakouts. There's only maybe one or two conditions where I'm going to be comfortable trading breakouts. So I almost never do. And you need to know your own personal strength before you create a strategy that's going to work with it. Because as I said, almost any losing strategy can be made positive with the proper inventory management, the proper structure management, and perhaps the proper tweak management. And almost any winning strategy I can destroy in 5 seconds flat with bad risk control and bad entry management that you can overlay on it. So, some steps to successful strategy development for us to take a look at. First, of course, we trade live, right? Trade live. We look at screens. There's no substitute for trading live. If you're, even if you're working all day long, you can trade live in off work hours. That's very great about the FX market, is that we always have a time away from work when we can trade, and the market is very active. Or you could trade literally on your phone. I mean, I do this all the time. You could, you can trade. MT4 is a great Android and iPhone app, and you could follow your trades on the phone continuously. It's not that hard. You could just glance at your trades while you're doing other work. And when you're trading small, when you're trading for dime pips or dollar pips, and it's not your paycheck and it's not your rent money, it's very easy to keep an eye on what's going on even while you're working. So trading live is very, very important. And of course, defining initial rules, right? What are you going to do? How are you going to do it? Sometimes, I love using the boogie board just to sketch out visually what I think is going to work, what I think is not going to work, right? Because I'm a very visual person, and it really helps concretize my my view. And then just even writing down, like, let's say you run 15, 20 tests, just writing down the results of what worked, what didn't work is also very, very valuable. So just defining all these things is incredibly useful to you as you go forward. Looking at the charts and going back is so important. I always look at every single trade I've made in the week prior. Look at everything that went right. Look at everything that went wrong. Look at everything that came close. In other words, I came close to stopping out here. I came close to, I barely escaped here. What happened? What was the context? Why was this trade going this way? Sometimes it's just the way things are. You just, you ran into a big buy order or sell order. Sometimes you should have known better because you were in front of a big piece of news and you got lucky, or you didn't get lucky. So constantly reviewing your price action on the charts, really, really important. Testing it logically in Excel sometimes is kind of valuable. Now, I'm very fortunate, and this is a really useful thing. Is if you have somebody who is a trader who can code, is really really, really useful. You almost all unless you're good friends with somebody or you can trade favors with them, you almost have to always pay someone to code. But in the end, it's almost always worth it because as I said, in the modern day trading, the robots rule. Even all of our trades would be impossible to trade on a manual basis. The logic, the order entry, the speed, the execution, the precision, all those things all go by the wayside if you try to manually, if you're just a point and click trader. So I really, really think it's important if you're going to, you obviously can just simply take our code. That's the best thing. And then there's plenty of free code on the internet. You can teach yourself how to code. That's a much bigger challenge, but a really valuable one if you're interested in computers. But if you're not, and most of the ideas are relatively simple, the people can implement them for you. And there's plenty of people on the internet that will help you code. I would really not worry about the proprietary nature of your ideas. There's nothing that you have thought about that somebody else hasn't thought about before. The value of your code will almost certainly be in when you turn it on and when you turn it off, right? It's not that the code itself is going to work all the time. It's when you turn it off that's going to be the difference between winning and losing. And that's something you're only going to learn, by example. Now, one thing that I absolutely abhor, this is why I almost never backtest with a machine, is that machine results are almost inevitably wrong, right? They're wrong in 100 different ways that you could never know because they take so much data, and so much of the data is dirty. And what I mean by dirty is it's impossible to have entered into that price. It's impossible to have exited a price because it was a gap price. It doesn't show that on the data set. The data itself could be wrong. The highs and the lows of the data set could be wrong. There are gaps in the data. There's just all sorts of stuff that either, for example, very often people will do a back test and it comes in with horrible results, right? And you're like, oh, this is a terrible idea. And they give up on it. And it could actually have been like the greatest idea ever. And the reason why it's terrible is because the code just simply was wrong in a huge amount of data points as to how it would have executed in real life. And conversely, there's so many people that come in with these perfect results that are almost literally 100% of the time end up in bankruptcy because the data fails them. So I never look at machine results, and that's why I don't really test failure. So you want to obviously, of course, refine, understand failure, come back again. It's always a repetitive, reiterative process, right? And one thing I always do is I always examine every single trade at the end of the week, and then I want to reassess. I mean, reassessing every 6 months is probably a decent amount of time, but I think even every 3 months you want to kind of reassess and say, what's working, what's not working, why is this working? Where's the market environment? What should I be thinking about? You constantly should be thinking about, what are the key things that are happening in the market? And so the key questions you want to ask yourself before you trade, sort of the basic questions, are the following. Am I trading intraday or daily? And I think this is where a lot of stuff that I'm just about to tell you is kind of very, very valuable. First of all, if you're trading intraday, you really do have to have 6 hours of a day where you're going to look at screens. Now, it could be 6 hours after you come back from work. It could be 6 hours before you go to work. It could be if you're working from home, 6 hours of the day whenever you're around. But you got to, if you're going to do this on an intraday basis, there is no shortcuts here. You got to give yourself 6 hours a day of screen time. So first and foremost, you got to ask yourself, are you willing to do that, right? And if you're not, then it's really, really much better to go on a much longer. And there's plenty of people. There's lots of people I talk to who say, you're crazy. Why, you're watching charts all day long. Why are you even bothering with 5, 10 pip trades? I want to be in 1,000 pip trades and in 500 pip trades. I want to be in long-term, big trends. My answer to that is that I'm just not good enough to pick, just like I can't tell you what the weather's going to be like in 2 weeks from now, but I can tell you what the weather's going to be like in the next 5 minutes. I like to bet on the next 5 minutes. But it's up to it's up to you on what works best. Um, and if I don't get to this point, I'm gonna circle back to this point about day trading. But the other couple of things that are very, very important, pairs to trade. It's incredibly important to understand that there's huge personality differences, volatility difference between something like pound yen and euro Swiss, which could have a 300-point range versus a 20-point range. And you're never going to get the kind of setups or the kind of structures that you're looking for in a pound yen are never going to appear in the euro Swiss yen, right? What times of the day will I trade? Now, the times of the day are so important. The most volatile time of the day, the single greatest amount of liquidity, 80% of all price movement will happen during this time frame. And any given day between 12 and 1600 GMT, that's London afternoon, New York morning. 80% of all price movement will happen during this time. So that's either good or bad. You're either going to get stopped out like a maniac because everything is going to be super volatile, or you're going to catch the only trends that are really going to be serious during this time frame. So you really need to understand what are the key times to trade within your trade plan, right? And now, this is a really, really important point, is how many trades will I make per day? So if you like to trade 5 times per day, right? Remember I told you about sort of leverage factors, right? And how much you should risk per trade. Well, if you're trading 5 times or more per day, like I do, you should never risk more than a quarter of 1%, 25 basis points per trade. And the reason why is because let's just do it very simple. Let's just say you trade 10 times per day. If you trade 10 times per day on no leverage whatsoever, you take $10,000 and you traded 10 times. What have you done now? You've taken $10,000, you traded it 10 times, you've effectively flipped over the inventory 10 times. You've now made $100,000 worth of trades, right? 10,000 times 10 is $100,000 worth of trades. So you've now increased your lever factor to 10 times, right? Now, if every single time you bet 1% of your money, and if you had just one bad day in a year, and you guarantee you'll have more than one bad day a year, where every single trade you did was wrong, right? You will in one day lose 10% of your money at 1% bet. That's why at 5 times or higher per day, you should never trade more than 25 basis point risk per trade. A quarter of 1%. Just want to stop right here and make sure everybody understands that. Everybody give me a yes in the room and tell me that you understand what I just said to you, because that is the single most important advice I can give you as far as proper lever factors within a day trading versus a swing trading environment, right? I don't see any yeses. Does everybody understand me? Somebody give me a yes. Okay, good job. Now, all of those risk 1% per trade, risk 2% per trade, risk 3% per trade, all of those rules that everybody throws around, those rules are only intended if you're going to trade like 4 to 5 times a month, where you're going to trade basically 50 times a year. It really comes down to, here's the basic question. If you're going to trade 50 times a year or less, then yeah, you could risk 1% per trade. If you're going to trade 500 times a year or more, then absolutely not. Absolutely not. That's the key thing to how you want to structure your risk. That's the single most important thing. Everything else is going to be secondary to how you structure your risk, depending on these two factors, right? And then the other thing that you want to ask yourself is, what hurts you more? What kind of a person are you? Are you a person who hates losing out on making 200 pips? Or you're a person who hates actually losing 200 pips, right? So I am very much the first type of personality, right? I hate to lose money, and I really hate to lose big money. It annoys me to no end. I don't care about 1,000 pip trade. I'd rather not lose 1,000 pips in a year. I always say to people, I will never, ever, ever have 1,000 pip winner in my portfolio, but I will also never, ever, ever have a 200 pip loser in my portfolio either. Now, if you want to have 1,000 pip winner, you're going to have a lot of 200 pip losers. That's just the nature of life. If you don't understand that, you just don't understand anything about trading. So if you're mentally okay, saying I'm perfectly okay losing 200 pips 3, 4, 5 times in a couple of months, no biggie, because I'm going for that 1,000 pip run in my account, then you're cool. But if you're not, then you have to trade a completely different strategy that takes advantage of your personality, right? And then, of course, you want to ask yourself, when do you want to do reviews? As I said, I always do a review at the end of the week on all my trades, and then you want to do a review at least 3 months and 6 months on the strategy. And generally, I think this is sort of a good advice. Once per week is best, and then once per month at least for the broader stuff. So, lastly, let's sort of leave our session here with some top trading lessons that I want to leave you with, and then we'll open up to questions. So, top trading lessons that I think really important. There are far more, these are not things that everybody tells you to, because this isn't about strategy. It's really much more about making the strategy work. You have to know yourself to know your trade. You have to know what you like to do, whether you like to take big risks or small risks, and then you need to understand how that trade dovetails with your personality, right? Revenge, never, ever sweet. Revenge trading is, and I know it's hard, God knows I've done it 1,000 times, but it is never, never, never a way to get money back. It always ends badly. It always ends really like this. Not using a stop is always a recipe for disaster. I'll give you a most recent example. I was out of the office, fooling around. Right, I took a day out of the office because I had a medical appointment, and the euro started to go down. And this is before the euro sort of really kind of came in for a very big dive. And I was like, oh, I'm going to buy some because it's clearly coming into support levels. And then it came down again. I go, I'm going to buy some more, and I buy some more. And I was buying small, But by the end of the day, it built up to sort of a considerable position. I was, way down in the hole. And I didn't have a stop because I was, of course, I'm buying small. I don't need to stop, right? And, of course, the position just kept going against me. And I started looking at this, and I said, this is really stupid. I have violated my first and foremost rule, which is I didn't trade with a stop. And so the euro rallied just a little bit, up, nowhere near where I needed it to be, to get back to even, but just enough to recover some of my losses. And I sold the whole position. Because I knew from prior experience that if I didn't, worse things could have happened. So just to tell you, let me see if I could calculate this properly. We're down, so it was 200 points. It would have been two. Had I kept, without even adding a single position, if I added, it would have been worse. But had I just simply kept the original position, no stop, as we stand today, that tiny little sort of starting position would have taken my account down by 40%. 40%, just by not using a stop in a matter of a week and a half. As it was, I was able to get out with like about a 4% loss. So I should be great. I've already worked back 2% of that loss back. But I'd say as good an example as I can give you. God knows I have 1,000 examples like this in my lifetime. But you do learn eventually to pay attention to these things. It doesn't matter how ridiculous it is. It doesn't matter how oversold, overbought, absurd, insane it is. If you don't have a stop, it will ruin at least 50% of your account, maybe even 60% of the account, much faster than you think. You think you may have, you may be able to hold up to this position for a month. No, because even on small leverage, if you keep adding positions, you will ruin 30, 40% because the moves could be huge. So always use a stop. Always use a stop. And pops and bottoms are only evident in the house side. You could say this is a bottom. You could say this is a bottom, and eventually this is a bottom, right? You can say this is a top. You can say this is a top. Then you can say this is a top. You can say this is a top. This is a top. This is a top, and it's not tops. So very, very hard. And then one other thing that I think is interesting, and this is for those people who like to do, let's say, single entry or multiple entry with multiple exit, right? What I found very interesting from people who sort of trade longer term trends is that they make almost all of their money. You know how they say like 20% of your salespeople make 80% of your money, and 20% of your trades make 80% of your money, blah, and so forth. Well, 20% of your position can very often make like 80% of your profit. What I mean by this is if you're in a long-term trend position, right? And it's impossible to hold on to the whole position because you need to relieve psychological pressure. You need to bank some profits. So you give up some money. You give up 25%. Let's give an example of dollar yen. Dollar yen was at 101, right? So it goes up to like 104. You give up 25% there. Then it goes up to like 107. You give up another 25% there. It goes up to 110. You give up another 25% there, and then you just simply hold the rest. You sort of hold the rest. And what happens is in a position like with dollar yen, where we've had this massive move, right? That last 25%, because the move has been 1,000 points, actually is responsible for like 80% of the profit of that particular trade. So that's a very, very interesting, valuable, and psychologically palatable way of making money, which is just leaving the sliver of your position once you've made some decent money in it to just let it run forever, for as long as you can, and see if it could really, you could get a 10-to-1 bagger on the position, right? And then last, and this is really, really important, trading is always about getting punched out. The market will always punch you out. There's almost not a day where you don't get stopped out. Every time you get stopped out, it's like getting knocked out in the ring, right? And so I always like to use this quote from Rocky VI, that it's not about how hard you hit, it's about how hard you can get hit and keep moving forward. That it doesn't matter how many times you get stopped out, as long as you can regroup, refocus, take a breather, and come back, you will have a much greater chance of winning in the long run. That's the key to how winning is done, and that's how trading is done. So I hope you guys have really enjoyed all of these sessions. I'm now open to any questions you guys have. Feel free to ask me anything. As I said, all of this is going to be on the website for at least a year, probably longer. All the materials are there for you. And if you have any questions for us, as always, feel free to email us at contact@bkforex.com. Let me see if let me put this email up here. Okay. So now I'm open to questions. Anything that's on your mind. You can ask me questions now. You can ask me questions later. If you can't think of any questions now and you want to ask me questions later, just email us at contact@bkforex.com. I'll be happy to answer anything that's on your mind. So I am looking here, and it looks like everybody is pretty content. I don't see any questions. If you guys are good, I will we'll close up the webinar. As I said, if you think about it, is can you mix long-term double Bollinger Bands with boomers on an intraday basis? We cannot download the recording. No, the recording cannot be downloaded. The recording can only be watched on demand. But you can download the PDFs. No, you can't mix long-term and short-term strategies, right? It's two completely different. The whole point of this presentation is they're completely different beasts, right? You can trade two completely different strategies. That's absolutely great. I think it's great that you have some strategies that are long-term, some strategies that are short-term. But you have to understand what each strategy does, how it fails, how it succeeds, what it requires. It's really, really important to understand, to know. You know what they say in sales, know your customer. In trading, it's know your strategy. That's the key thing. Any other questions, guys? Anything else on your mind? Well, thank you for hanging out with me. I had a blast hanging out with you guys. Thank you for actually getting up early Asia Sunday morning and hanging out with me early in Australia. All of this, as I said, available to you guys to watch for as many times as you want. Feel free to email me if you have any questions. I hope you guys found all of this very useful. We use all of these principles every single day in our chat room. For those of you who are not in the chat room, I invite you to come in and come hang out with us. I think you'll find it very, very interesting, especially now we're really I'm starting the new year very, very excited because we have a deadly combination of trend and counter trend strategies on the short side, on the short-term trading side that I really love. That's been working very well. And we hope to really light it up in 2017. So everybody have a wonderful, wonderful new year. Happy holidays to everybody across the world. And I hope to see you guys in the BK chat room. Thank you again for hanging out with me. I'll see you guys in the markets. Take care.